that introduction. I'll introduce you in the session.
Is this where you want to be?
Yeah, then I think, there we go. So, hello everybody. Welcome to the webinar. I'm Bill Hodgson. I'm the guy who runs the OTC space. And we run the webinar with George, who is an expert on MiFID. Surprisingly, he's not European, but yet he has to understand MiFID for all of us. Because it's a global regulation in a way. Anybody doing business into Europe has to comply with MiFID whenever it comes up. So MiFID got delayed by a year, so it doesn't take effect until 2018, but it is a hugely complicated piece of regulation. The trading side of it tends to apply to the cash markets, bonds and equities, but the trading part of it and the conduct part of it and the reporting part of it tend to apply to all markets. So one of the reasons I wanted to run this was that, George, you can flip through the other points so I can see them. The reason I wanted to run this because George, in his article on the web, showed that depending on the jurisdiction of your firm, your counterparty, the product, and the trading location, what you do in your order management system becomes very difficult to know. And as we get towards the end of the slides, I mean, we have got a slide that George put together that tries to show what it is you need to do, but it's the tip of the iceberg. So if you haven't found it already, in the software control panel you're using, there is two sections you should look at. One is downloads or handouts. There's a couple of PDFs there for you. And the other one is questions. So whilst George is presenting, myself and Samantha, our other team member, will be watching the questions panel. And if we can, we'll answer your questions as we go along. And the other thing we'll do as we go along is the 3 polls we're going to put up to do with your understanding of MiFID. So George can get some feedback as we go along. As to what your level of understanding is. So I think that's all the introduction I need to do, isn't it, George? And then we're into your slides.
Okay, thank you, Bill, and thank you all for joining. Let's start out to let you know that there are 2 decks available. The one we're going to go through here is the abbreviated one because there's so much material and so little time. Most of what was added in the longer deck was the actual wording from the various rules, so you can see and not rely on someone to tell you what it says. So let's understand a bit about the way this all gets put together in the European arena. The European Parliament passes either something called a regulation or something called a directive. Regulations have to be passed by the member states as is without change. Directives, the member states have to pass something that accomplishes that directive. And it is those rules that actually are applied to market participants. So here are the items that are out there. MiFIR, and where it says officially called, that's important because in the European regulatory environment, they're referred to this way, not as MiFIR or MiFID II, or the Market Abuse Regulation, or MAD, but by MAR Regulation EU number 596/2014. So here's what the European Parliament has passed, and then ESMA, the European Securities and Markets Authority, issues something called Regulatory Technical Standards, RTSs, and the MiFID RTS is officially called that, and it has a set of annexes, and the Market Abuse Regulation, MAR, is officially called this, and has a bunch of annexes. And you can get all of these on the website here. And the RTSs are like 500 pages, so there's lots and lots of reading that you could do if you haven't already. So let's stop here and take a poll in terms of where you are in your preparation. So you should be able to see the poll there. If you could just fill that poll in while we're going ahead and let us know where you stand. So let's move on to two of the big concerns that are not mentioned terribly specifically in the rules, but are crucially important. So the first one is something called third country status. And what do we mean by third country status? The rules apply, MiFID and MiFIR particularly, apply to firms that are headquartered in Europe or have a presence in Europe. The big question is, what's the applicability for a firm that has no presence in Europe? Do these rules apply? And as we go through them, we will see that there are some very sticky points here that make this question extremely important. So we've had 81% voted, but we'll wait just a bit longer before we close the poll. First thing to understand is that the rules here are applied at the legal entity level. So a large bank, a large asset manager could have lots and lots of legal entities, and in each case, those rules would have to be applied at the legal entity level. Okay, we've had a little stop, so I'm actually going to close the polls, and I will show the results. They should be out there for people to look at. So first thing to understand is you have to look at this at each entity. So you could have a European bank. That same parent company could have a non-European bank, could have a European broker-dealer, could have a non-European broker-dealer, etc. And each of those we have to make a determination. Okay, so let's look at what they actually say about third country firms. That is, a firm which is headquartered outside the EU. If you have a branch in Europe, that entity is now subject to MiFID and MAR and can deal with any customer in the EU. If you don't have a branch, MiFIR says that your home regulator can establish regulatory equivalence with ESMA, and then your home rules apply, not MiFID. But you can only deal with the categories they call professional or eligible customers, not retail customers. And MAR and MAD don't really have this. When we get to MAR and MAD, we'll see that there is a completely different view of what applies. An individual customer that passes certain sort of categories can, in fact, elect to be treated as a professional and then come under this. If none of this applies, then ESMA says this firm, this legal entity can't deal with EU customers. And given that the actual applicable rules here are country by country, it means that each member state has to pass something that says unless you qualify under one of these, if you're outside the EU, you can't deal with EU customers. So the question then is, when we look at whether to become applicable, or whether to become in scope or not, we have a set of questions to be asked. And what's the implication of deeming ourselves to be out of scope? So on the good side, if we're out of scope, you're only dealing with your local rules and regulations and regulators. So you're not subject to MiFID trade reporting, which we'll see is a bit of a problem. You're not subject to pre-trade transparency, which is fairly intrusive. And you're not subject to some of the conflicts that are within MiFID and MiFIR, such as things like trading obligation and best acts. So your you're not subject, if you're an asset manager, to the MiFID unbundling rule, which we'll also see has some implications. So your order management system requirements may be quite a bit simpler. If you say, I'm out of scope, now the question is, what happens if the European regulators say, we don't think you're out of scope because you're dealing with EU customers? So ESMA says, if you're going to deem yourself out of scope, you can't deal with any EU customers, and you're not supposed to deal with EU instruments. The big question people are asking is, if this legal entity is completely outside the EU, doesn't have any presence there, can ESMA or any other regulator do any enforcement? Well, one of the questions that people have been trying to parse out is, if you're a parent company or if you have an affiliate inside the EU, is the regulator likely to take some action against that EU entity in order to try and enforce this? There's been no particular indication, but it's clearly something that people are concerned about. And one additional question then is, if the EU regulator thinks that you're in effect breaking the rules, even if you're not there, and you want to expand your business or have a growth strategy down the road, will this relationship the bad relationship with an EU regulator, will that hamper your ability? We've determined in looking at MAR that the market abuse side of this is much more difficult to say you're out of scope, largely because we expect the worldwide regulators to cooperate quite extensively in dealing with market abuse. So even if you're outside the EU and your customer is outside the EU and nobody touches it, if you're dealing in an EU instrument and there's some indication of abuse, our feeling is that you're not going to be able to escape those implications. So the first question is, are you in or out of scope as a firm? And for however many legal entities you're dealing with, they all have the same kind of question. Second question is, what rules apply at what point? And so applicability, we've determined, is one of the major issues that every firm that's dealing with MiFID and MAR, et cetera, will have to deal with. The concern here is that some rules are applicable when the firm is in the EU. Some rules are applicable if the customer is in the EU. And some rules are applicable if the instrument is issued in or traded in the EU. So we can start to see that lots of different combinations can cause different kinds of rule applicability. One of the more common that we've seen is that two European parties, two EU parties, do a swap, do a transaction in a US, in effect, domiciled swap. Completely different set of rules than two non-EU entities doing a swap that's domiciled in the EU, like a total return swap in the DAX or something like that. So as the firms are going through their business and their transactions, we'll get those events popping up one after another, and the rules are quite different. And it's not really helpful if one of the participants in a transaction is outside the EU, because some of the rules will apply even if one of the firms, let's say the investment firm, is outside. So here's an example of this sort of thing. EU asset manager does a transaction with a non-EU firm in an instrument that's listed or traded in the European Union. Trade reporting is required. The broker-dealer, the asset firm, is not in the EU. They say, we're out, we don't have any obligation. The asset manager would have that obligation for trade reporting. So it's a fairly complicated set of applicabilities. And if we looked at a transaction that had two components to it, for example, let's say we had a fixed income trade that's US based and a swap that is EU based. So one set of rules applies to the securities transaction, another set of rules applies to the swap transaction. And it's way too complicated, where our view is, and most people agree with us, way too complicated for people who are processing these transactions rapid fire to have any real ability to, on the fly, fix this sort of thing. So our view is that firms really do need to have not only broker-dealer firms, not only banks who are market makers, but asset managers and even commercial firms that are dealing in some of these markets are going to have filtration logic built into their order management systems to keep them out of trouble. So now let's get down to some of the specifics of the rules say, and we can start to see why they're important. Before we get into specifics, though, let's look at some definitions. Here, this is the definition of an investment firm, which includes portfolio management firms. And this definition, as it's expressed, doesn't say EU only. This applies to any firm that performs these functions. Later, when they talk about EU investment firms, they're talking about individual applicabilities. The definition of a financial instrument is in Section C, and once again, doesn't restrict itself to instruments in the EU. So as you go through these rules, you'll see these terms, and when it says an investment firm, it means any. It'll say EU investment firm or third country investment firm otherwise. When we get to market structure, we'll see why these are important distinctions. So this is a multilateral system operated by an investment firm, which brings together third-party buying and selling interests. An OTF, originally MTF actually was in MiFID I and applied to equities. OTF, second definition, is the same definition but for bonds, structured finance products, initial allowances, or derivatives. So in the swaps world, OTF is the important component. Systematic,
George,
yes.
can I ask a question about derivatives? Do you know if the fact that there's a definition of an organized trading facility, how will that impact derivatives trading, such as direct over-the-counter or brokers? Does everybody have to start using something called an OTF? For instance, will all CEFs become OTFs? What do you foresee happening?
So yeah, a CEF and an OTF are essentially the same. When we get to the trading obligation, we'll see that they have some fairly specific definitions of what has to trade on an OTF versus over-the-counter. But one of the intriguing things about their definition says that a systematic internalizer is a market maker over-the-counter in instruments that trade on these facilities. So they appear to be saying that you can have over-the-counter transactions with systematic internalizers for products that are listed on the OTFs and the MTS. Part of what they're going to be saying, and they're still trying to put together some of the final definitions, is illiquid items, large trades, if it's listed on an OTF, you can still do that trade over the counter. But they have to put together what are liquid and illiquid and what are the size transactions that are allowed to be off the exchanges. I'm not sure, Bill, if that answers the question.
Yes, thanks.
Okay. So we will use these terms throughout, and they're used extensively throughout all the documentation, just so we know what these definitions mean. And let's then get into some of the specific items, which we'll then go into in some sort of detail. So MiFID and MiFIR, and they don't say the same thing. They cover actually different aspects, and in a couple of cases say something different about the same subject. It's a collection of rules that were put together sometimes without any recognition that there's another rule, even in the same document, that has some slightly different view of things. But here's the sections that we're going to look at. The trading obligation, which says what has to trade on what venues. Transaction reporting and post-trade transparency, two different rules about what has to be reported after the trade. Transaction reporting is the kind of thing that goes to a regulator, and post-trade transparency is the kind of thing that you would see on a ticker, or a media publication about what transactions have occurred. Best execution, which has gotten a lot of press, about how customer orders have to be executed. And when we get into this, we'll see some fairly different views of what has to be done for the customer. Pre-trade transparency, what market information has to be made public, and that's actually quite, some of that is a little disturbing. What these entities are, can do, and can't do, how they have to operate. And something called inducements. Inducements actually came in a delegated act, not in the original documents. But how soft dollars have to be handled, and algorithmic trading, which is a question of what electronic forms are allowed and how they have to operate, and what customer or what dealers have to do, and asset managers as well. Remember, these apply to investment firms, and one of the areas that is an investment firm is an asset manager. So this will apply to that. All of this is expected to go into force in January of 2018. There's been a delay already, so it's actually fairly unlikely that we'll get a significant delay in the entire program. We may get delays in one or two pieces of it if people are concerned about, in particular, whether the regulators can fulfill their obligations. That tends to be what causes delays. Amar and Mad, talking about market abuse, really two main areas that it covers. One is insider trading, what it means, who's responsible for surveilling, and market manipulation. So the definition of what constitutes and who's responsible. And we're seeing that some of these definitions, we'll see when we get into it in detail, are different from what is in some other jurisdictions around the world. Their view, Europeans' view, is that this applies to anyone who trades or deals in or does orders in instruments issued or traded in the EU. So wherever in the world, their view is this applies. It has a format specifies for reporting, something they call stores, and those reports are different from some other fairly well-known reporting requirements. But one of the big differences that everyone has been trying to deal with is that Mars says that unsuccessful attempts to manipulate are culpable. This went into effect in July, and what we're seeing is that firms are attempting to become compliant. When we get into the specific section of that, we'll take a look at what can or can't be found, and what are the risks there. All right, so time for a little second question here, and that has to do with personal understanding. So if we could vote on that one, and I will begin talking now about some of the specific items in MiFID and MiFIR and how they apply. What we're going to do is we're going to specifically talk about how the rule is applicable, what causes it to be applied to transactions, and we're going to talk about how they differ from rules in other jurisdictions, so you can see where there are some potential crossed wires. And we'll see in particular, in several cases, how these two sets of rules tend to conflict with each other or potentially cause a problem. And then we'll talk a little bit about the kinds of things that you'll need to do to stay out of trouble across all of these areas. So let's begin with one that has gotten quite a bit of press, and that is best execution. And this is driven by where the customer is, not where the product is or the investment. So a transaction in a U.S. product for an EU customer is subject to this rule. It is only applicable to orders. Essentially, it says that the investment firm must take all sufficient steps to give the best possible execution to customer orders. If a broker-dealer or an investment firm makes a market and a customer executes off that market, there isn't an order.
George,
yes.
do you want to show us the result of the poll and then show the slides?
I'm sorry. Sure, yes. Can we see now the results of that poll? Okay, so we have almost half of the people who've responded say they need to learn a little more about it. So hopefully that's what we'll accomplish some of it here. So as firms talk about what their plans are for MiFID going forward, one possibility...
Can you put the slides back on?
I thought they are on.
No, we're looking at the poll results at the moment.
Oh, sorry.
It's okay.
Got it.
Tell us me. Okay. Carry on.
Yeah. So firms are starting to say, if I move much more to a bid offer customer executes versus doing orders, less of this will apply. But it has three main requirements in it. The first is how trades are going to be handled, and that's something that most geographies, most jurisdictions say something about, so that's not too new. This one actually is, which is what has to be given to customers, and we'll see that there are some things that have to be given to customers which are not generally seen anywhere else, including venue reporting. And what you have to be able to prove to either a customer or a regulator up to 5 years after the fact. And that came as a bit of a surprise to some folks who are saying, I now have to store tons of things about transactions I've done for customers for up to 5 years. And as we look at this and how some firms are currently doing business, we're starting to see some changes. Some firms, a lot of what they do is fairly compliant, but no more rebates for order routing. That's specifically called out in the rule. So for some firms, that's a change in their income stream and in their practice. For riskless principal, there was originally the view that riskless principal would be prohibited because by definition, it wasn't the best price that a customer could get, in that I had a markup or a markdown. But the view now is that if the markup or markdown is the equivalent of a commission and is revealed to the customer beforehand, then the transaction is allowed. But transactions where we have some sort of credit exposure with the customer, so a forward FX or a swap, where in order for us to do that trade, we have to do it with a particular, the customer has to do it with a particular counterparty. Those transactions are being looked at very carefully, and in some cases people are moving from an order structure to a bid-offer customer decision structure in order to get away from this. And the way firms communicate with customers, and we have to remember that the rule applies not only to broker-dealers, but also to asset managers. So asset managers now have a responsibility to take all sufficient steps to make sure that they have best execution for their customer orders. So desk policies, both the broker-dealers and asset managers, will have to be shared with EU customers. They're not required to be shared with customers in other jurisdictions. There is a requirement to receive execution metrics from various venues, and those have to be sent to customers, EU customers, on an annual basis. And dealers will have to capture and save the market data to prove best X after the fact. So if you're acting as a systematic internalizer and you're executing customer orders, you'll have to keep market data. Even if you execute on a venue, you have to keep market data in order to prove after the fact, up to 5 years, that this transaction was done at best X. Most other jurisdictions have some form of best X requirement, but they're not the same as this. And so firms are starting to say, oh, I'm going to have to separate out the orders I execute for my EU customers in order to give them some of the communications, etc., that are required under this rule. So best X, it's actually gotten quite a bit of press, and firms tend to be fairly far along with that one. Transaction reporting has gotten also a good deal of press, but firms are sometimes less knowledgeable about what this, once again, this requirement is driven now by the instrument, and it applies in theory to all parties who do a transaction in that instrument. So opposite of best X. And one of the requirements for reporting is if the underlying of any instrument is an EU-based instrument itself or index, then the trade has to be reported in the EU, even if the main instrument is reported elsewhere. So a typical example of that would be a structured note issued outside the EU, where the structured basis is the DAX, for example. That would be reportable both in the country where the note is issued and in the country where the underlying is issued. Where a dealer does, or a firm, investment firm, does back-to-back trades in, say, riskless principal and including syndicate, both sides of the trade are reportable. And one of the things that's caused a certain amount of consternation is trade reports have to have identifications of the account holder. For a U.S. customer, that would be Social Security number or tax ID. For other jurisdictions, it might be things like passport number. And this has caused some customers in the U.S., for example, to say, I don't really want my tax ID number floating around in Europe. So let's see if we can do these trades outside of this whole requirement. It requires additional identifiers for the trader to place the order and decision makers. So when you think about an asset management firm, the account holder might be a pension account. The trader might be the trader inside the asset manager, and the portfolio manager are all required to be put on the transaction report. And any algorithms necessary for the investment decision making. Among the transactions listed here are compression and termination. So it isn't just the things you would normally think of as a trade, but also a set of other things. And this has caused folks a certain amount of trouble as well. Transaction reporting can be done by the venue, the trading venue, an exchange or an MTF or an OTF. But if you're relying on them, let's say you're an asset manager relying on them to do that, all of the information that's necessary, including all these identifiers you see above, has to be in the order in order for them to report. So order transmission to European venues is now a much bigger deal. They have the transaction reporting requirement for MiFID has more data elements than EMIR, also covers more products. EMIR was primarily for derivatives. So you can use the EMIR reporting if you expand the reports to include this additional information. But as we look at this now, we can start to see why a firm might very well want to say, this entity over here in Latin America or Canada or South Africa or Australia, this entity is a third country outside of the EU, so this doesn't apply. So my nationals who do a trade in an EU instrument, I don't have to do all this because I'm not in. And you can imagine that there would be some conflicts with some of the European regulators over what must or must not be done. So those are two that have gotten a fair amount of publicity and discussion. We're going to get into some now that have had much less, but have very significant impact. So the trading obligation, so this is by the instrument, it says any party that trades in this instrument is subject to this rule, and it says if it is traded on an EU venue, no matter where else it's traded, if it's traded on an EU venue, then the trade must be done either on that venue or on an equivalent venue outside the EU, or if allowed with a systematic internalizer. So the key here is if it's traded on the European venue, we don't care where else it's traded, this applies. So if you're already transacting all EU instruments on EU stocks exchanges, there isn't an additional impact. But we're already starting to see in Europe a significant growth in dark pools. And if a dark pool is not considered a venue, a listed venue under ESMA, then that dark pool business may have to be moved to a different. There's no guidance on dually listed shares. So if we have a share that's listed on a non-EU exchange, and the bulk of the business being done on that non-EU exchange, if it's listed on an EU venue, and if that other venue isn't considered equivalent, then according to this rule, all parties must do transactions on the EU venue. It's pretty clear that's not going to be workable or perhaps enforceable, but it's an issue that's out there. So now to get back to the question Bill raised a little bit earlier, for a derivative, if the instrument is not mandatorily cleared, then this doesn't apply. But if it is mandatorily cleared, then only transactions with non-financial corporations that are below the NFC plus thresholds. This NFC plus and minus came about during MiFID I and EMIR, says if they have 3 billion of rate swaps or 1 billion of CDSs, they're above the threshold, and this applies. So clearable swaps with financial customers or NFCs above this rule, the requirement to do this applies. For FX or fixed income currency, there's no trading obligation. And one of the questions that people will have to think about is non-EU firm dealing with a non-EU customer in an EU instrument, does this apply to them? And we're going to have to look at that in some detail, and people are going to have to make decisions about that. So one of the things we've identified as a potential issue is a duly listed transaction or a derivative that is both listed and over the counter, and the best price is available outside of this obligation. The firm is stuck between a rock and a hard place, in that they either do a trade where it's required under the obligation, or they have to give their customer best execution and in effect violate this rule. We've not seen anything from the regulators, from ESMA, et cetera, that gives any indication of how to resolve this kind of a problem.
Hello, George.
Yes.
I'll just say you got 15 minutes left, but there's also a funny noise coming from your end.
Yes, I know. The local fire whistle has gone off. I can't make them stop. Sorry.
Okay, everybody, you have to bear with George. It's the fire department. All right, carry on.
Yeah. Okay, so pre-trade transparency. Once again, this is somewhat unique to the European venue, but this is by the instrument for all of the parties that we're going to list. So this is required no matter where the parties are. So it applies to a market maker or the operator of a venue. And venues can be request for quote, for example. It says anything that any bid or offer, any actionable indication of interest that is supplied to a market must be made available to the public as actionable. And among the things that means is if I go as an asset manager to a broker-dealer and ask for a price, whatever price they give me has to be available to everyone, and that includes RFQs. So that might very well mean that as an investment manager, I want to go somewhere to do a trade outside of the EU people who are subject to this, in order that the broker-dealer can give me a price that he can execute on, which is better than what he would show to his competitors. Because the key to pre-trade transparency is anything I show to a customer has to be showable and executable to a competitor as well. And there's been a lot of consternation about this. In fact, at one point, ESMA was told that this would probably change the spreads. Part of the concern that people now have is that we're moving more and more toward algorithmic trading in very rapid time frames. And the question is, if the computer is willing to do a transaction in a very rapid time frame, what constitutes making it available to the public? And in cases where we're dealing with instruments where the transaction might move the price, the communication method between a broker-dealer and a customer may have to change, and that means that the investment manager may not get to see what is the best price that the broker-dealer would do, and that may impact the best execution requirement as well. So this kind of transparency is not generally found in other venues. People who are doing over-the-counter trades in fixed income, for example, aren't facing this same kind of problem. And so once again, we're seeing that BestX and this rule may make it very difficult for asset managers to do their transactions. This is actually now, unbundling is actually part of the delegated acts. It is driven by the customer. The EU customer of an investment manager only applies to investment managers. Says commission dollars can only be used to pay for execution. If you currently have commissions that are partly to pay for execution and partly for research, you have to now, if you want to continue that, create a research payment account, which customers will fund, and you use that. You have to set the contribution level annually up front. You can't exceed that budget during the year. You have to report to these customers what they purchased with their dollars. The alternative is for investment managers to opt to pay for research for themselves. And right now, investment managers worldwide, because remember what this applies to is a US, Canadian, Japanese asset manager who has EU customers, and there are some definitions of what a customer is. So these are now prohibited, a lot of them. They are prohibited in some other jurisdictions, but they're explicitly prohibited here. And so when we see firms doing block transactions and then allocations, if they're doing those in an area where unbundling like this doesn't apply, they're going to have to split up the allocations. Unless, get back to that, they say, we're going to deem ourselves to be out of scope of all of this. Considering that riskless principal markups are supposedly commissions, this may apply here, but probably not to other principal trades. So if as a broker-dealer, I'm giving my customer a principal price that includes research, that may work, but the commission side of it will not. So a quick look at market structure. And once again, this is by instrument for all parties. One of the things it says in there is that the operator of an MTF or OTF cannot commit its own capital in those transactions. Okay, so single dealer networks, the typical Autobahn, whatever electronic network is a case where the broker-dealer is using this to solicit order business and committing their capital, will not work anymore. It'll work outside the EU, but it won't work in the EU. So the people who are running single dealer platforms in the EU are having to decide if they're going to pull out of that and become a systematic internalizer, OTC market maker, or run the OTF. It says not only can you not commit your capital on the MTF, OTF, same legal entity can't run both. Can't be an SI and an OTF at the same time. So this is the fundamental difference between Europe and the rest of the world. How we handle orders, people are still working that out. And once again, this breaks down for an asset manager who has some EU clients and some not. And you can't accept inducements under Best X for EU customers, but you could for non-EU customers. So we're seeing investment managers now having to make more decisions about how they route orders because this impact has started to play. And as we're seeing more and more of this order routing being done electronically, it means more and more of this has to be built into an OMS. So let's look at the next poll. If we'll take a quick look at what we're going to be using, there should be now in front of people the poll for how we're going to utilize our OMS. Yep,
George?
Yes.
I'll just say, we're 4 minutes away from an hour, so you've got, I can see you've got a few slides left. You might want to, people can download the slides if they really need to read them. It's a question of which bits of the remaining slides are really important to get to the table at the end.
Okay. Oh, I got you.
We can overrun a bit. We can overrun a bit, but people normally book out their diaries, and so I notice that they tend to drop off after the hour. So the optimum time is an hour. That's it. Anyway, you can show people the results, and off we go.
Yeah. Okay. So here's that result. I'm guessing that there are some folks who are not really too familiar with what their OMS looks like. All right. So algorithmic trading, the key to this is anything that breaks up an order is considered an algorithmic, and this applies to. If all it does is decide where to put it, doesn't apply, but if it breaks up the order or looks at pricing or anything else, which means most of the execution management systems are under this, this is not as bad as the CFTC's Reg AT. So if you're going to be complying with Reg AT, this is not as bad as some others. So let's quickly go into MAR and MAD. It's driven by the instrument. If firms already surveil for insider trading in other areas, probably okay here, but doesn't include attempts. And in the US, the SEC doesn't want to hear it about EU. So there needs to be additional done. This requires both people and systems, and many firms do not monitor orders. So we're seeing lots of people having to greatly expand their monitoring to cover orders over the same time period that they're currently covering. And the insider trading requirement in Europe is what the old requirement was in the US. So it is not applicable. The safe harbor that the US courts have given is not applicable there. There is a wide variety of activity for market manipulation that needs to be monitored. The problem is you're supposed to know you have to know the motivation, and it's very likely that you could go 20 years with a very good system and never see anything, partly because no one ever did anything, or partly because they were able to successfully hide it. Once again, this is different from lots of other jurisdictions where orders are culpable, not just trades. So for an asset manager, investment manager, any transactions done for customers, any transactions done by the firm itself, or any transactions done by employees. And we're going to need to have definitive metrics to make all of this work, and there aren't any metrics anywhere that I've seen supplied by the regulators. And most of the time, if you see something happen and you want to find out if it was culpable or not, the prohibitions against tipping off say you can't go to the potential party and ask them. So this is an area where people are looking at just being able to demonstrate that they have something that they're not likely to be able to be 100% certain that they found everything. So let's look at, see, we're going to be okay. So let's look at this. The first question is whether the rules apply to a particular entity, and that's not really a slam dunk decision. That's based on what your growth plans are, what your strategy is in the marketplace. And once you say yes, then you have to know which rules apply to which transactions, and you can't expect people to do that manually. So the place where that has to happen is in the OMS, and probably there rather than EMS. But to the OMS structure that says, here's an order that's going in, what instrument, what customer, which rules apply, and go and find a piece of logic that will apply that. So we put together a symbol matrix here that says, as far as we know, this is where the rules apply for Europe. The actual matrix would have to be several times this size because we need to know the same thing for other jurisdictions. And nobody that we know in the vendor space has this. So our view is that firms now need considerable help in constructing a way for them to deal with these problems, these rules, and not run afoul of the regulators. So we're happy, CMA is happy to talk to folks about what they're doing and how to get themselves involved. Most firms' compliance teams are already involved in some of this, but you generally
George,
need to. Yep.
I got a couple of questions for you, seeing as we're right on the cusp. Emmanuel, it's on your questions panel, but I'll tell you which ones to look at. Somebody asked, is there a scenario where a third country firm, a non-EEA firm, will have to do transparency reporting?
Well, so the European regulators are going to tell you that if you make a market in an EU instrument, you're going to have to do that. Now, once again, if you have a branch there, then yes, you have to. If you have no branch but regulatory equivalence, the answer is no, because your local regulator has whatever the rule is. But we're fairly sure that the EU regulators are going to say this applies to everyone. The question is whether they can make it stick.
Okay, so there was one other question from Theodora, and this is more complex. I'll read it out, see if you can make sense of it. So under which asset class are structured notes considered for post-trade transparency and liquidity assessment?
Okay, so a structured note would normally be considered a fixed income, but in MiFID, they have the term structured products, and they apply various rules to the term structured products. So the rules call out that particular instrument directly as a separate class. So you have to go back and look at the applicability of each of those and see which part of the rule applies and which does not. But the European regulators specifically identify structured products as a separate category.
Okay. Robin, who I know is also a MiFID expert anyway, pointed out that some FX and fixed income products are not yet subject to trading obligations because they're not defined as liquid. But if they are defined as liquid, then they may become mandated to trade. So this is a comment rather than a question.
Yes. So an NDF, for example, would be considered an instrument that's subject to that. In general, spot FX is not, and typically what's called an FX swap, which is two sides of the transaction separated by a settlement date, is generally not considered a subject, but currency swaps, options, NDFs are generally considered. The question is, when does that part kick in?
Okay, so Emmanuel had a follow-up question, which is a good one, about how do you define a non-EU firm. So taking the example of an asset manager, do you use the domicile of the fund manager, or the trader?
Okay, so if an asset manager is headquartered outside the EU, and they have an office in the EU with people who are doing transactions, that's considered a third country firm with a branch. If they have no presence, no people, no presence in the EU, then the question is, who are their customers? And the rules are quite explicit to say that the headquarter of the pension fund or the UKITs or whatever is what determines the domicile, not the holders of that set of assets. So a mutual fund that's headquartered in Europe is considered an EU customer, while a fund that's headquartered in the US and has EU customers in it may not be. I'm not sure
Okay.
if that, it's a complicated question. So.
Oh, no. So, Emmanuel, George, if you want to scroll through to your contact details so that people know how to get in touch with you,
Okay.
I'd suggest that if people have got more detailed questions, then they may as well email you directly.
Right. So here's where you can get a hold of me by both phone and email. CMA has done a lot of work in this area, and we're happy to talk to folks who are wrestling with some of these problems about how we can efficiently help people get on top of them so that they can get on with the real business of their lives, which is to make money.
All right. So if anybody else has got questions, now's the time to ask them. But I'd like to thank you, George, because I know an hour isn't time to do justice to everything, but I hope that the people on the presentation learned something from all of that. And if you need more information, George is there and available. More than happy to help. And
Yes,
so
thank you all for your attendance, and hopefully this first scared the heck out of you and then said, oh, we think we know how to get it fixed.
All right. Thank you, everybody. I can see people logging off. So it's time to go now. And thank you for coming along.
Thanks.